Okay, welcome back. I think I live in Switzerland. People in Switzerland are very punctual, but in Sao Paulo, even more punctual. Everybody's here on time. Okay. So let's talk a little bit about risk. Tomorrow we talk more about risk. And right now it's just the notion of risk for under IFRS 17 and. I like to start this part with a test. Okay, so here we have two situations. On the right hand side, first on the left hand side, there's a man with equipment, parachute, and everything. On the right hand side, there's a man without parachute, without shirt, without shoes, okay? So, in which case is the risk of dying higher? Who has higher risk of dying? Who says, this guy? This guy. Raise your hand, no? Well, only one person, okay? So, the rest of the people would say this guy has higher risk of dying. Well, I think whoever said this guy has higher risk is right. The guy on the right has no risk, right? So it's going to die. It's going to die. So risk? No, don't laugh. Risk is there's certainty. There is certainty here. Because I know the outcome already, so there's no risk. If I know the outcome, there's no risk. Here, I don't know the outcome, so this guy has higher risk of dying. The other guy has no risk. There's no risk. He's going to die anyway, right? So this is the concept. But then let's look at it more mathematically. Okay, so basically, risk is everything that is related to uncertainty. I know a new word. What did you say? What did you say, Máris? Incertidumbre en español, pero no, incerteza. I love this word, incerteza. Okay, so there's no unique definition, but usually we say probability of negative outcomes, etc. For us, risk equals probability of loss equals uncertainty equals chance. Now, there was a Kolmogorov, Russian mathematician, who basically created these axioms of probability and created this probability space where we have omega. Here, omega is the sample space of all realizations, little omega belonging to big omega of an experiment. Then we have F, this stylized F is an algebra that contains all sets to which probability can be assigned, and then we have this stylized P, which is the probability measure. Now the idea here is that normally we are going to model a random vector, okay, and then we know a vector is an arrangement of numbers, okay, that goes from omega to the real numbers in d dimensions, right? Because it's a vector, okay? So how do we do the modeling? Basically through distribution functions. So we have the big F, and the big F is the CDF, the cumulative distribution function, and so this is nothing but the probability that x is less than equal to x, where x is element of the real numbers, and this fx, but this one is a vector, is that the probability that this vector x, and then this is bold, this is not bold, is less than equal x, where x is element of the real numbers in d dimensions. So we do the modeling through these probability distributions, okay? And the main focus are insurance, market credit, and operational risks. But there are other types also model. I think I put here operational, and this we should take away. Operational is here. Okay, so this is a more formal approach, and basically when it comes to risk, we have these two paragraphs that are relevant. So 37 says that the adjustment of the present value of cash flows should be adjusted to reflect the expected compensation. I require compensation because I'm entering some risk, right? I'm absorbing risk, and if you think carefully, risk insurance companies are the primary absorbers of risk in society. Okay, we like risk. It's not that we dislike risk. We like risk, but we should be good at managing risk. But we say we welcome risk. We take risk from society, and we put it in our business, right? And then we have to become very good at managing risk. In contrast, banks dislike risk. Okay, banks do not like risk, but we should like risk, but we should be good at measuring it. Okay, so in society there are many industries. Our industry is the one that we act as primary absorbers of risk in society. Now, not all risks are insured or insurable. That should be clear. Okay, so I say here that for now we are going to say that this risk adjustment can be compared with the risk margin under Solvency II. Okay, with a slight difference in context. What's the difference? That basically for Solvency II, risk is kind of the same for everybody, right? Whereas for IFRS 17 is entity specific. Okay, then we have B87, so it's paragraph 87 of Appendix B. The risk adjustment measures the compensation that the entity requires to be indifferent between A, fulfilling a liability that has a range of possible outcomes arising from a non-financial risk, and B, fulfilling a liability that will generate fixed cash flows with the same expected present value as the insurance contracts. Okay, so now these words are perhaps a bit heavy to understand, but it's going to be very easy if you look at that diagram. Now in this diagram, we have two contracts. Contract 1 pays 1,000 with probability 50, pays 0 with probability 50%. Okay, so expected payment or weighted outcome is to pay 500. Contract 2, outcome 1 pays 600, probability 50%, or pays 400, probability 50%. So the weighted outcome or the expected value is also 500. Now, in which one there's more risk? Okay, so that's the idea. So evidently there's more risk in the first contract. Why? Because the dispersion or the outcomes are so different. 1,000, 0. Here the outcomes are closer, 600, 400. So I should be able to require more risk here than here, right? So you see the idea. because of the uncertainty. Okay? Good. Now, again, no prescription how to calculate risk, but we have, basically, we can have lower risk adjustment in certain circumstances. For example, if there's high claim frequency and low claim severity, we usually have less risk than the other way around, that if there's low claim frequency and high claim severity, okay? For example, natural catastrophes. I see that Brazil is not as exposed to certain natural catastrophes, for example, earthquakes and catastrophes that we have in other parts of the world. You don't have many of these catastrophes. I guess you have a flooding risk quite a bit, yeah, but no earthquakes, right? No. Hurricanes, no hurricanes, no. Yeah. 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 So that's an example. Natural catastrophes is an example. There are risks that occur every 5 years, every 10 years. So very low frequency. But when you are hit by an earthquake, it's catastrophic. Now the U.S. is of course, is the biggest insurance market in the world, and they have a hurricane season that is constant because it starts on June the 1st, it ends at the 30th of November, and they know, Americans know, that every year they will be exposed to hurricane risk, all right, to hurricanes. And these hurricanes, this is just geography. They originate in the Sahara Desert in Africa, so as tropical storms, and then as they cross the Atlantic, they gain temperature, and the waters get warmer, and the air starts to get even also warmer, and then these tropical depressions sometimes they turn into hurricanes when they are reaching the American continent. They turn into hurricanes, and usually they go north. And certain countries like Mexico can be hit twice, in the Yucatan Peninsula and then in the Gulf of Mexico, right? Or usually they go north to Georgia, North Carolina, all these states, and then they create this tremendous destruction. So in a way, they are, Americans know that they are going to be hit by hurricanes, so they expect these hurricanes every year, more or less. And also, these hurricanes have other risks, which are like flooding and some other natural catastrophes. But earthquake is much different. So that would be a difference where you have a higher risk adjustment. Then short-term, lower risk adjustment, long-term, higher risk adjustment. Less skewed probability distributions, low risk. More skewed probability distributions, more risk. And so on. More information, you have low risk. Less information, you have higher risk. Okay? So for example, cyber risk. Do you have cyber risk policies in Brazil currently? You do. Okay. Which is an example of a very difficult risk to price, because the risk changes, right? If I have a car, the car is not going to change. Okay, maybe the car gets older, but the risk is basically the same, or the car is linked to the driver, whatever. But then the risk doesn't change. But in cyber, right? If you put another application in your system, everything changes, right? So it's a risk that is dynamic, and it's very difficult. It is very difficult to collect information. So that would have higher risk adjustment. Okay, this is the last, emerging claim experience that increases uncertainty of future estimates. So again, no guidance, but certain ways of considering the risk adjustment. Now here we have approaches typically used. So at least the first one is a characteristic of a probability distribution that is used by Solvency II in Europe, which is the so-called value at risk, which is a quantile risk measure, okay? So what Solvency II says, let's take the 99.5 percentile of the distribution, which is to expect a loss, one loss every 200 years, that's 99.5, okay? So this is the infimum X element of the real numbers, such that the cumulative distribution at that level is greater than or equal to alpha. And then Solvency II says alpha equals 99.5%. Okay, so that's the risk measure that is used. Okay, so in other words, we have a distribution, or we calibrate a distribution or an aggregate distribution for the risk that I'm going to face, and then I take simply a quantile measure. Now in Switzerland, I said before that Switzerland is not part of a European Union, so we don't follow the Solvency II. We have another capital standard that is called SST, Swiss Solvency Test, and we use something, we use the second one, which is TVAR, tail value at risk, which you see is basically here what we are doing is that we put this thing, we put it inside the integral from alpha to 1, okay? And then we divide everything by 1 minus alpha. And this is like the average of the worst results of the distribution, okay? Tail value at risk. So these two approaches are very common. The banking industry likes very much value at risk, and the Solvency II uses that approach. Now there's another approach that is called cost of capital, and cost of capital is basically risk adjustment is cost of capital, which is a number. Sometimes it is prescribed times the present value of the solvency capital requirement. Now, Solvency II says that CC, cost of capital, is 6, right? 6%, right? And SST, Swiss Solvency Test, says that cost of capital is 6%. Why 6? Well, I don't know. I asked one guy who was pretty much responsible for the Swiss system, and he said jokingly that 6 is a perfect number because 1, 2, and 3, 1 plus 2 plus 3, 1 plus 2 plus 3 is 6, and these are the divisors of 6, right? But it's kind of a industry norm to take 6% for the cost of capital. So you simply multiply the cost of capital times the present value of the solvency capital requirement. Now, the trick is to calculate the solvency capital requirement. We're going to see tomorrow ways of calculating that solvency capital requirement. Okay, so this is yet approach number 3, and approach number 4. This is basically loading your assumptions, okay? So those of you who practice on the life side, normally there's this loading of assumptions. So what you do is that you load the mortality table, you add some factor, whatever, and this is loading of assumptions. So that's another way to account for risk. Now, what IFRS 17 says, you need to disclose what is your method, and then you also need to disclose the confidence that you have in the confidence level that is associated with your calculation. And then I have a footnote here that says this is a non-exhaustive list, but this is what companies are basically doing. And I would say one advantage in Europe is that companies have dealt with Solvency II for many years now. So that's I know that you already have the Brazilian solvency already in place, but the thing is that I think Europeans have thought about Solvency II for many years. So when IFRS 17 comes, it's not as a challenge. Maybe I don't know if this makes sense or not, but I think it's going to be a little bit more challenging for countries where the risk-based solvency concept is relatively newer than in Europe. I don't know if this is if this applies to everybody or not, but that's one thing. If you are used to Solvency II, when you see IFRS 17, it has other complications, but at least the risk adjustment is not as difficult, maybe. Okay. And then again, tomorrow we speak more about risk. But before that, here I have an example. In this case, we have 1,000, no, not 1,000, 10,000 policies, and look at how we calculated value at risk and tail value at risk. So we have the number of people here, first column. So this is 10,000. Then we have the sum insured, different sum insureds by age. Okay, so these are the different ages, and this is 5QX. So what is 5QX? This is the probability of dying from age X to age X plus 5, right? So I have these numbers here, and then you see already, you see some couple of things that are expected. First, this number is increasing with age, so which is like a normal thing. Okay, the older you get, the higher the risk of dying within a 5-year period. So that should be okay. And then you also see that these numbers, particularly before age 50, are rare occurrences. So death is or premature death is relatively a low frequency event. Okay, so nobody's expected to die at younger ages. Still, you have accidents, and anybody can die at any age. That's a given. But nowadays, the risk of premature death has been mitigated by better health, better hygiene, etc., medical advances, and so on and so forth. Now, what is the risk? The risk, and I saw in the news that these Previdencia reforms in Brazil. The risk is that people, like, I understand that here what's important is the years of service, right? So if you collect certain years of service, you can retire at age 55, I think, right? So what's the risk now? The risk is that you outlive your retirement assets. The risk is that people are going to live long, very long. So somebody retiring today at age 55 still has a few years to live, and the issue is whether the money is going to be sufficient. Then I calculate here expected benefits, which is this times this times this, and so that's this number. And of course, here I have more decimal places. Okay. Then I calculate the variance, okay? So what's the variance? The variance here in this case, well, basically I have the, like this second moment, so I multiply by the square of the benefit, okay, times the probability, and then I deduct the expected value, so I have the variance here, okay? Now, so this is a 5-year single premium term insurance, independent risks, and independent and identically distributed risks. Only mortality is considered, and expenses are, just for fun, 25% of gross premium, and that's it. So I have an expected benefit amount, this 206, which is the sum, should be the sum of this column. Then I have a standard deviation, which is the square root of the sum of this column. Then I have a pure premium, which is a function of the above. Yeah, I can't remember how I calculated this, but yeah, but it's some expected value times, or maybe it's a characteristic of a distribution. I need to go back and see. Then I have the gross premium, which is this grossed up by 0.75. Because of the expenses. Then I have a value at risk number, and how I calculate the value at risk? Well, I use the Máris said this morning the law of large numbers, right? And basically what I say is that I have 10,000 random variables. I take the sum of everything, and then I'll calculate the distribution, because I assume that the sum of a large number of random variables has a normal distribution, all right? So for the normal distribution, I have a compact formula for the value at risk, okay? Which is the expected value times, what is it? 1 over 1 minus alpha times the cumulative distribution function of the normal distribution at 0.995%. So I get this number, which is like, what is it, 2.57 times? Yeah, I have a 2.57 in my mind. I'll tell you later on what is that. Now I have the shifted, okay? So what's the difference between the value at risk and the shifted value at risk? Is that I take the difference between the value at risk and what? And the expected value, because remember that risk by definition is deviation from the expected, okay? So for this business I think we should look at this gross premium, 316, I would have a capital of 49, according to Solvency II. According to the Swiss system, I would have 50,000, a little bit more. Okay, and how I calculated the tail value at risk, I also have a compact formula for a standard distribution. So these formulas, go to Wikipedia and you find the compact formulas for value at risk and tail value at risk under the normal distribution. But not all distributions have compact formulas. For many, you have to do your simulation, your stochastic simulation. Here is very easy. You can do this table in Excel. If you're interested, I show you how to calculate all these numbers. Okay, so that would be an idea of how to calculate for this type of policy, how to calculate the risk adjustment. So this, either you take this 49 or you take this 50, almost 51, any of the two, and this is. In our simple example, this is the 75 that I showed you at the beginning, right? So the 75 risk adjustment for non-financial risk is either that or that. I put the two numbers just to make the point that it depends on how you want to measure risk. And also, here I put 99.5 for the value at risk. For the tail value at risk, I put 99. Which are, by the way, what the Swiss do. The Swiss put 99 here. Solvency II puts 99.5. But this is the average of the worst values. Okay, so it's by definition it's a bit higher. So you decide on the methodology, you decide on the confidence level, but you have to disclose. That means that in your financial statements, you have to put notes to the financial statements, and then you have to basically to say how you calculated risk. Now, what are you going to do? Well, basically, this is a job for the actuary. Typically, is one of the jobs of the actuary. Many of the jobs here in IFRS can be done by other people, by accountants, by IT people. But this type of thing is purely actuarial work. Okay, discount rates, again, we saw this before. Okay, so I'm not spending much time. Here, basically you take observable market prices with the same characteristics in time, currency, and liquidity. If these characteristics are not available, or similar instruments are available but do not separately identify factors of a financial instrument that differentiate it from an insurance contract, then estimation techniques must be used. And then these are the three things to consider: observable inputs, non-market variables, okay? That these non-market variables should not contradict observable market prices, and a lot of expert judgment. So in this example that I told you earlier, This is the chief actuary of a very large insurance company in the United States, also represented, by the way, in Brazil, among other countries. He says that they have a team of economists. They determine the discount rates, and then they present these discount rates to him, and then he gives his input. He makes the final decision, but he doesn't calculate anything. He gets the work done by a team of experts, economists, financial experts, and then ultimately he has to make the decision. So you may argue that the discount rates are also responsibility of the actuary, but not necessarily something that the actuary does. Okay. Now challenges, and I think in some markets sometimes it's difficult to know or to replicate cash flows, because not every instrument is available, right? So in some markets you have more, for example, interest rate swaps and derivative instruments. Some markets may not have that sort of instruments, so that's the market illiquidity challenge could be something to consider in certain markets. And then the difficulty in identifying support for the adjustments. So how do you assess liquidity risk? How do you, if there's lack of price for corporate debt, that's also difficult. Justification of using illiquidity premiums of advanced financial markets. So it's a different, it's kind of a theoretical aspect, one of the most theoretical aspects of IFRS 17. I think the risk is relatively easier if you have done Solvency II, but then the discount rates, how to account for liquidity and things like that can become a problem. Okay, so we are running a bit late. Do you have any questions here? Okay. Yes, one question.
Hi. So we spoke about declaring the risk adjustment at a confidence interval, and the example you did was the mortality risk. But there would be other risks that drive the risk adjustment. So let's just say you have the underlying distribution for all of those risks. How do you combine them into one confidence interval for your risk adjustment? Or do you declare the confidence interval of the individual risks?
No. Yeah, you declare for the individual risk.
Okay.
But how the calculation is included in the discount rates, right? Because these are, or this is basically they take into consideration financial risks as well.
Okay.
Mm-hmm. Okay, so I'm going to switch now to reinsurance. Yeah, favorite subject of Ron here. Okay, so. So I have a reinsurance held and contracts acquired, and let's talk about reinsurance held. Okay, so reinsurance held is the reinsurance that you buy from Ronald, right, or from any other reinsurance company. Yeah, from Ronald. Okay, this means reinsurance held. If you're an insurance company, you can also reinsure, or it depends. In some jurisdictions, you need a different license, but in theory, you can reinsure as well. So this is when we speak about reinsurance held, this is reinsurance that you buy from Ronald, right? So it says, in applying measurement requirements to reinsurance contracts held, the entity shall use assumptions that are consistent to those used in measuring the underlying contracts, because the reinsurance that you bought from Ronald is reinsuring a block of business. Now, the assumptions should be consistent. That's clear. In addition, not Ronald, but some other reinsurers may not perform, right? So if you reinsure, you are transferring risk, or in a way you're mitigating risk, you're transferring risk to another party, but you add credit risk or counterparty default risk. Why? Because the contract that you establish with the reinsurance company is independent of the contract that you establish with your policyholder. So you cannot say, Mr. Policyholder, I cannot pay you because the reinsurance company hasn't paid me. That's not the way it works, right? You have two different contracts, and even if the reinsurance company won't pay, you still have to pay to your policyholder. That's why reinsurance, the credit quality of reinsurers is something that companies typically look at. Okay, they want to be sure to work with solid reinsurance companies, and but anyway, there's little risk. Even if you go with the big ones, there's very little risk, but there is risk. Okay, of non-payment. Okay. Now, paragraph 65 for reinsurance. Okay, there's no unearned profit. Okay, so in the determination of the CSM, but instead a net cost or a net gain on purchasing the reinsurance. So on initial recognition, you recognize any cost or net gain as contractual service margin, which is the sum of fulfillment cash flows, amount derecognized of any asset or liability previously recognized, and any cash flows arising at the date of recognition, unless this very strange situation, the net cost of purchasing reinsurance relates to events that occurred before the purchase of the group of reinsurance contracts, in which case the entity shall recognize such a cost immediately as an expense. Okay, so this is very very strange, but I guess they have to also take into consideration this strange condition. So here, let me show how it works. Let's assume we have done the initial recognition already. So we have, in this example, we have 1,000 of inflows. I think it was premium. Then we have the present value of outflows, difference being 350. We have the 75. So in this example, this is a given. We have the contractual service margin. Now, let's say that in exchange of a premium, a reinsurance premium, the entity will cede 20% of each claim to the reinsurance company. Okay, 20% of each claim. I'm not saying if this is quota share, or I'm not saying anything. I'm saying 20%. Okay. If you want to think quota share, maybe that's easier, but could be other form of reinsurance. Now the premium is going to be either 120 or 150. Okay, so we have the two examples. Now suppose in the next table that the premium was 120. Here, when I say premium, this is the reinsurance premium. Reinsurance premium. Okay, so I have here initial recognition of reinsurance health. So I have here the inflows, and the inflows are the recoveries, okay? The recoveries from reinsurance. And then the outflows, what are the outflows? What are the outflows? The outflows is 120 or 150, all right? The premium that the reinsurance premium that I am paying to the reinsurer. Now, here we have the two situations, either 120, 150, but here is the reinsurance company is going to pay 20% of the claims. That was the arrangement, which is the same number, right? Now, in the first case, we have, well, there's a difference between the two in that the fulfillment cash flows have different signs. Here we have negative, here we have positive, all right? So here is that we have a contractual service margin that is, we have to put the same number, even though we said that there's no negative contractual service margin. And notice that this 20% is 20% of 75, okay? So here we ignore the risk of non-performance for simplicity. There's no unearned premium. Okay. So before we have here two columns. One is the insurance liability, the other is the reinsurance asset. And here I say here, I assume 40%, not 20, I assume 40, because it doesn't have to be identical, right? Perhaps there could be some differences owing to timing of cash flows or any difference. So what I'm doing here is that I have, this is the insurance liability, okay? So I have my contractual service margin, and at the end of, so this is before end of year, this is at year end, right? So the fulfillment of cash flows include change in estimates, okay? And I have this basically from here to there, I'm applying paragraph 66, which in effect is the difference in this 20. Here I have a 20 difference that goes here in the second line, right? So I have a profit or loss from the reinsurance contract held of 0, okay? So here, what I have is the net of the two. Now, if we look at the, first, let's look at paragraph 66, okay? So entity measures the reinsurance contracts held as the current amount determined at the start of the period, adjusted for the effect of new contracts added to the group, interest on contractual service margin, as before, changes in the fulfillment cash flows, okay, to future service, right? The effect of any currency exchange, the amount recognized in profit or loss received in the period determined by allocation of the CSM should be, CSM remaining at the end of the period before allocation over the current and remaining coverage, okay, just as before, okay? So what is at the end? What is the loss to the company? Well, we have this situation in which the insurance liability is 110, and here the reinsurance asset is 44. So there's a loss of 60. Okay. So again, what's the bottom line here? The reinsurance is considered an asset. Okay, and then this will change my profit. But before we said that for the cash flows of the underlying contracts, you don't take into consideration reinsurance. So it's like you do the cash flows without reinsurance, and then at a later stage you determine what is the profit or loss of this reinsurance contract. Okay, so they do it separately. Okay, now insurance contracts are acquired. Okay, insurance contracts acquired. Now this situation is when I acquired a block from another company. Okay, so this is the meaning of insurance contracts acquired. It's not reinsurance. It's simply that I take over a block of business of another company. Okay. So B94, an entity shall use the consideration received or paid. Okay, so this is whatever money exchange the transaction brought about. Okay, as a proxy for the premiums received. So it can be positive or negative. So I can pay to get a block of business, or I can be paid to assume this block of business, depending on the profitability issue. So the consideration excludes consideration for any other assets or liabilities acquired in the same transaction, okay? In a business combination, the consideration is the fair value of the contracts at that date. So what IFRS 17 says, you can acquire a block of business or you can acquire a company, okay? If you acquire a company, this is called a business combination. If not, it's called contracts acquired, okay? Now, in this example, the entity acquires insurance contracts from another insurance company. The insurance contracts form one group. The entity, which is not necessarily the case. In this case, we say it's a one group, but could be different groups. The entity receives a payment of 300, and on initial recognition, the fulfillment cash flows are either a net outflow of 200 or 450, right? So where's the this is how the arithmetic works. I have a net flow of 200, okay, here, or 450. Positive net flows are really positive net outflows, of course, are expenses, are liabilities, right? And then I have the contractual service margin, okay, to make up the 300. But here, since I have basically I receive a payment of 300, but then the net outflow is larger. So what's my CSM? CSM cannot be negative. So it's floored at 0, and then here I basically have a loss on initial recognition of 150. Otherwise, I don't have a loss. What do I have? I have contractual service margin of 100, and then this 100 I treat it like the examples that we were considering before. So again, in the first situation, in both cases, I had to I received 300. All right. So I took the block of business, but I received 300. But in case one, okay, the net outflow is 200. So that means that I have 100 profit. So this 100 is a profit. But in the second case, even if I received 300, the net outflow was 450. So I have a loss, right? So is this real? So I acquired something and then it was loss producing? Well, I don't know. Maybe there were other conditions, whatever, but then this 300 is what I received to assume this block of business. Maybe I received, I don't know, the right to sell to the customers or any other thing, right? Because if I present it like this, you are going to claim, well, I'm receiving 300, but I'm acquiring more net outflows. Yeah, well, the story is that this is the accounting for insurance contracts. And bear in mind that other things, like for example, where do I remember that when we were talking about cash flows, we said, what about other cash flows that are not related to the block of business? For example, I may have a building, all right? So if I have a building, this building is an asset. And then I have depreciation. Where do I put this depreciation? Well, that's not accounting for insurance contracts. IFRS 17 is only accounting for insurance contracts. I have also to do other accounting entries, other things, right? So the depreciation of the building is an expense, but this is unrelated to IFRS 17 because it's not related to the contracts, okay? So many people said, oh, and all the, inventories and all, this is separate from IFRS 17. So you have to apply different standards. Maybe you have to apply 15. Maybe you have to apply 9, right? And so on and so forth. Okay. Now, 95, B95. Unless the PAA is used, and we haven't spoken about the premium allocation approach, but we will do that tomorrow. On initial recognition, the contractual service margin is calculated applying paragraph 38 for acquired insurance contracts issued and paragraph 65 for acquired reinsurance contracts held, using the consideration received or paid as a proxy for the premiums. So whatever I received or I have to pay, this is the premium, right? If acquired contracts are onerous, the entity shall recognize the excess as part of a goodwill or gain on a bargain purchase for contracts acquired in a business combination or as a loss for contracts acquired in a transfer. So that's the difference. If it is a business combination, I have to use another standard, right? Bargain purchase. Or as a loss, in our case, if it is a transfer. The entity shall establish a loss component of the liability for remaining coverage for that excess and allocate subsequent changes in fulfillment cash flows to that loss component. And we haven't yet spoken about the loss component, okay? So what we have spoken about is that if there's a loss, you recognize immediately. This flows directly into your balance sheet. Still, you will have subsequent losses, right? Because anyway, your accounts are earning interest, and you are basically recognizing that in the insurance finance expenses. And also remember that that you have this risk adjustment, which you are also releasing. So this release from risk is also flowing to your profit or loss. Okay, so that's always the case. But we have to disclose the loss component, and this is yet another chapter of IFRS 17, how to disclose the loss component. Okay, we haven't spoken about that. For now, we have a very simple profit or loss statement and also a very simple balance sheet, but we need to do the disclosures. Okay, so that would be the difference between the two. Okay, so this is in this example. This is similar to the previous one, except that here is a business combination. So what's a business combination? Well, think of it as a merger or as an acquisition. So you're not acquired certain contracts, you are acquiring a full operation, and then there's a standard called IFRS number 3. Okay, so IFRS number 3 is how to do the accounting for business combinations. Okay, so at the end is different standards, different accounting treatments, and here basically again I received 300 on this business combination. All right, so here it is, but here I have 0 and 0. The excess of fulfillment cash flows over the fair value is recognized as goodwill. All right. Very good. Okay, so any question here?
I have a question.
Yep. You do it.
No, she's bringing one.
Oh, okay.
Of course, the reinsurance slide. Can you go back? The reinsurance slides, yeah. You're making the great assumption that the insurance company knows what the reinsurer is pricing at to create the asset. Or does the insurance company get input from the reinsurer what the asset is?
The assumption that what?
You're making the assumption the insurance company has bought reinsurance.
Yeah.
Great.
Yeah.
From RG, of course.
Right.
And he has to create the asset.
Yes.
But the insurance company has to make assumptions what the reinsurer is pricing at.
Yes.
Which can be completely subjective, right?
That's why I put here, yeah, that's a good point.
No, just...
That's why here I put the 40%.
Yeah, okay.
Yeah, I put the 40% here just to put something different.
Yeah, but like in the US markets where they reinsure like 35%, that's a huge number.
Yeah.
In Brazil, they probably, in life, they reinsure 1 or 2%, so not a big deal, but...
1 or 2% of what?
Of the total premium. Brazil cedes very small amounts for reinsurance.
Because it's
a long story, yes.
Yeah. Okay.
We'll go into there right now.
Yeah.
But the US, they cede like 35%.
Yeah.
But
Right.
the Brazilians
But
cede
this
very
is a good point. You understand what Ronald is saying, that you have to make assumptions about you're assuming what's the value of the asset, right? And so what they say is that your assumptions should be consistent with the block of underlying policies. But you don't know what the reinsurance company, what kind of assumptions they are making. All the information that I have here is how much premium he's going to charge me, or they are going to charge me. That's all I know, right? So in exchange, that's why I say, and this is interesting. I didn't say quota share. Had I said quota share, then we split 80-20, everything. But here they are charging me 120 or 150, regardless of the premium level, right? In exchange of 20% of the contract. So that's a good point. Yeah. Yeah. All right.
One more question.
Yeah, sure.
So the CSM for the insurance could be negative, right?
Yeah.
The CSM for the reinsurer could be negative. I saw a negative number there, but not for the insurance company.
No.
Right. But the reinsurers could go negative.
Exactly. Which is another question. If you're a reinsurance company, you also have reinsurance for reinsurance companies, which is called retrocession, right? But for IFRS purposes, being a reinsurer or being an insurer company is the same thing, right? So you also have to do your groupings and everything. And by the way, for Solvency II, the same. So if you're a reinsurance company, you also have to apply Solvency II, right? Well, if you have to apply it, like if you're in a European Union, whatever, you have to do your Solvency II. Okay, so we have finished earlier than expected because we didn't do the exercises, or well, we looked at the solution, and so we have what should we still have a half hour to go, I think, no? This was, no, but which presentation was this? Number 3 or number 3? We have number 4, no? No, sorry, we still have number 4 for today, yeah. So, yeah. So number 4 is are a few thoughts about implementation, yes. Yes, we need to talk about so we are good in time. Yeah. So, because we are supposed to finish at 5, right? Yes. Yeah, okay. Mm-hmm. Exactly. That one. Considerations for the implementation. And then this session, because it's the last session of the day, this is supposed to be also to be a little more interactive, that if you have comments, ideas on the implementation, let's discuss them. Now, one thing is the data management and the selection of engines, which we are going to see tomorrow. But for now, general thoughts about implementation issues, right? So first, transition, okay? So what's transition? You are doing your accounting, your IFRS 4, whatever you're doing, but then you will have to do IFRS 17. So there's something called transition, right? When you adopt IFRS 17. Now, IFRS 17 has to be adopted retroactively. That's one important thing to consider. But first, let's look at the timeline, okay? So basically, in May 2017, IFRS 17 was issued, was published, and then you have with the effective date of January 1st, 2021. But then they said, no, it's not going to be 2021. It's going to say 2022. All right, so they delayed that for 1 year. But you can adopt early. Okay. If you do that, you have to disclose that fact, so which is obvious, right? So if you adopt early, you have to say that you're adopting early. Now, early adoption is permitted for companies that apply number 9, right? So number 9 is also very useful statement, reporting standard, sorry, which is accounting for financial instruments. And also there's another one called 15. So 15 is revenue for contracts with customers, okay? So if you apply these two, and maybe some companies don't have to apply number 15, but some companies will do. For example, if there's a contract where there's no substantial risk, then this is accounted under number 15, and some companies will have to do that. So if you apply both 9 and 15, you can adopt early number 17. Okay, so in the timeline, here's 2017. Then 1st of January 2018 is the effective day of changes to IFRS 4 and of IFRS 9. Okay, and then the new date is going to be 1st of January of 2022. Okay, so if your fiscal year starts on or before 1st of January 2022, you will have to basically publish the results, your financial reports, under IFRS 17. So that's the deal. Now, why was the delay of 1 year? Well, there were many issues that the IASB received, and they wanted, companies wanted more time for all the complexity. Now, remember that there are companies in insurance that are, in the insurance industry, companies that are very, very big. For example, Allianz or AXA. These companies are incredibly big. How big? Well, they may have 1,000 legal entities or more. They operate in 130, 140 countries. Okay, so they operate in many jurisdictions around the world. And at least I know one that is not as big. Is Zurich. So Zurich is one of the big companies, but not as big as AXA or Allianz. AXA and Allianz are the biggest in the world. Zurich is I don't know, in the top, I don't know, top 20 or top 15. It's big, but just not as big. You know how much Zurich pays to the auditor every year? The Zurich Insurance Group. And the auditor is, there are 4 big companies, called the Big Four, okay? Deloitte, EY, PwC, and KPMG. Now, Zurich selects, every year they select one of these companies. They have their own internal process and everything, but they have to disclose how much they pay. So how much they pay their auditor per year in US dollars to make things easier. Give me a number. You're very good estimating. Give me a number. So audit services. And the provider is PwC, which is public information. Is $50 million. 50. So what's 50? That's 1 million per week, right? That's 1 million per week. Yeah. Now, this is what it is. Why is that? Because they imagine the number of companies they have in the world, the number of legal entities. So this is for the audit, right? Now with IFRS 17, I think it's going to be even higher. I don't know. But there's a lot of for IFRS 17, the audit process is going to be even more complex. Okay. So these are big, and I'm speaking, and this is public information. If you download the annual reports, I usually download the annual reports of the big companies, and I like to read about them. They are incredibly huge operations, and these are the companies that ask for a delay of 1 year because of the complexity. Okay. Now, perhaps our companies are smaller, maybe not. Also, there are big companies operating in Brazil, and complexity is also an issue because if you think that AXA or Allianz are very complex companies, yes, but they operate in hundreds of jurisdictions and markets around the world. But the thing is that whether we are prepared, we have the resources and all the infrastructure to cope with it. Now, what happens at transition date? Well, we have to do step one, de-recognize for, okay? So here I de-recognize, so I strike out all these things. So this is the balance sheet as I know it today. So I have a reinsurer's share of liabilities, I have deferred acquisition costs, I have a value of business acquired, I have premium receivables, I have policy loans in the assets. So I de-recognize. Liabilities, I have insurance contract liabilities, I have unearned premiums, I have claims payable. I may have other things, but these are the usual suspects. So I de-recognize, I recognize 17, and 17, I only have insurance contract assets, reinsurance contract assets, insurance contract liabilities, reinsurance contract liabilities. Normally, here I will have reinsurance assets, and normally here I will have insurance liabilities. But I don't know, there could be exceptions. And the net difference goes into equity or capital, okay? So the net difference, plus or minus, is the difference, okay? So step one, de-recognize 4. Step 2, recognize 17. Step 3, put the difference in equity, okay? Now, retrospective application, as if IFRS 17 always existed, okay? Now, are you going to do retrospective since 1950? Well, no, it's not relevant what happened in 1950, but maybe, I don't know, maybe back 15 years, maybe 10 years, depending on the situation, okay? Now, they already recognize, the IASB recognizes that companies will not have information in many cases, okay? So they talk about impracticability. If it is impractical to do if it is impracticable to adopt IFRS 17, then you either go for modified, retrospective, or fair value, okay? If it is not impracticable, you go to full retrospective approach. Now, full retrospective, you have sufficient historical information, basically on a per policy basis, basically on a cash flow basis, per policy, right? Not many companies will have that. So the bulk of the companies is going to be here, fair value approach, okay? So this is basically the decision diagram. Now, full retrospective, okay, measures each group of insurance as if 17 had always been applied and de-recognizes any existing balances that would not exist had 17 always been applied. Challenges. Well, you have to determine the cash flows on initial recognition, okay, and you have to identify all changes since initial recognition of all contracts, okay, that would have adjusted the CSM. Can you do it? Well, Francisco already says no. He was scared, now he's running out of this room, right? Yeah, applying the aggregation requirements based on the original expectations, okay? So you have to dig back and discover what were the original expectations 10 years ago. I think this is unrealistic. You can go back 1 month, but 10 years is impossible, right? Identify direct participating contracts. Now, that's another complexity. Direct participating contracts are contracts like, I'm going to say now unit linked, but these contracts where there's some investment component. And then determine the cumulative amount of insurance finance income or expense recognized in the other comprehensive income. So this could be the challenges. And not many companies will be able to do that, right? To go for the full retrospective approach. Then, I didn't sorry. I'm a mess here. I didn't translate this, but you understand, right? So, flujos de efectivo reales up to 1st of January, okay? Now, let me translate this, and I'll show you this tomorrow. Sorry, I forgot. Now, let's look at a modified retrospective approach. So this is in case where it's impractical to do the full retrospective. So we assume here that at transition, the entity estimates the present value of cash flows to be that number, 1,240. Risk adjustment of 200, contractual service margin 40. Between initial recognition and transition, the entity receives premium of 2,000 and pays 400 in claims. So here are the numbers. So where's this 1240 is here, okay? So I have this estimate of future cash flows. I have the effect of discounting. I have this. Then I have the risk adjustment, and this is given, 200. So I have this number at transition date. Then adjustment to initial recognition, right? Basically, here I have, where's the 40? The 40 is here, okay, which is the risk margin. And there was here in the third column, we have basically the net of the first two columns. All right. So basically, you have to consider what happens at transition date, what happens, what is the adjustment to the initial recognition, and that's, well, I guess you would read this table from the right to the left. You have the initial recognition, the adjustment, and then what happens at transition, right? So what's the idea here? Basically, you have some initial recognition, and then the adjustments that you would consider to basically have the amounts that are required at transition date. Mm-hmm. Okay. Another one that is not translated, but I'm going to read this anyway. So this is the fair value, okay, valor de mercado. So solamente when you cannot apply full or modified, the entity can determine the contractual service margin like as follows. So this is the contractual service margin equals to the fair value under IFRS 13, right? By the way, in Spanish we say NIF instead of IFRS, NIF, N-I-F-F, Norma Internacional de Información Financiera, number 13. So this is the fair value approach, and then we deduct the fulfillment cash flows. So that would be the story. Again, I'm going to have this translated as well. Right? Yeah. Yeah.
So the question that will have a lower impact on the P&L, right? Yeah, about P&L impact.
Yeah, I don't. Yeah, there's no
rule, right?
No rule. Yeah, because you use the third one if you don't have information, right? If you had information, I don't know if your auditor says go with the fair value, that's okay. But I'm not sure how this works, but somebody has to make the decision whether to use the full approach or modified approach, and decide how to.
Yeah, because from a practical perspective, the first one seems impractical.
Yeah.
The second one could be.
Could be.
The third one seems easier, right?
Yeah.
Because there's a lot of work to.
Yeah.
In a prospective manner. So,
Yeah.
a determination of MSC for the stock.
Yeah.
seems easier. But again, if we get a negative MSC,
Yeah.
seems you will chart the P&L.
Well,
if positive,
Yeah.
you know, from first time adoption, should go for the P&L as well, or we should?
No, but here
you-
they don't preclude the possibility that you get a negative number. No? It could be negative. First, you measure the market value, the fair value of the contracts acquired, of the fair value at the transition date. No? But for the fair value, you use this number 13, right?
If that's negative for first time adoption,
Well, if this is
Should hit
what
the
you're saying, if this number is lower than that,
the total margin.
it's negative,
margin,
yeah.
Yes. Yeah.
you
So,
recognize a loss.
Yeah, seems it's no. Probably it's going to be a gain, right?
Well, could be anything. Could be a gain. Could be a loss.
Okay.
Yeah, but I guess it's unlikely. I would say it's unlikely to be a loss, because if it was a loss, then it would. I mean, if it is a loss for the whole company, so I would suspect that this is not common that this is a loss, right? Because basically you are an ongoing operation, and that means that you are that all your contracts are losing. That's very strange. And then remember that the fulfillment cash flows takes into consideration what's going to happen in the future. So yes, you may have some contracts that are losing, but in the overall value should be right. Now, I guess one of the complexities is also the expectations that you have when you issued the contracts. But then you have to do your groupings as if IFRS 17 was always in place. So this is practically impossible. It's practically impossible. I think, did you present, Ronald, a slide of the who is? No. What you present is what stage they are in, right? Yes. The companies, not the transition, right? No. No. Okay. I think I saw a chart, but these things are not easy to get. There's no Solvency II. You get more information, but IFRS 17 is difficult. Now, again, Spanish. Yeah. Okay. So. This impact outside of actuarial and outside of accounting. Okay, so you will have the red. These are basically sample operations. Okay, so where you have the green is no impact. So things like marketing, yeah, no impact. Manejo de marca, how do branding, no impact. Distribution channels, no impact. Fraud and detection, no impact, and so on. Where you see yellow is some impact, for example, sales, underwriting, capacitación, legal services, risk management, internal control, audit, performance management, etc. So you have more impact moderado or potentially high. Where you see red, portfolio strategy, pricing, reserving, product planning, product development, claims management, reserve management, you have a lot of impact. So you could have potentially a lot of impact in your operation. And as I told you, what we offer to our clients is we basically say, what's the operational impact in your company, okay, and not necessarily with what's the financial impact. That's the other part. The financial impact is how the profit is going to emerge, okay, and the first part is how the operation is going to be impacted by IFRS 17.
Budgeting and capital management seems a red one as well, because we are required to do normally 3 years budget. Nowadays it's already hard, with all the uncertainty, it's including harder.
No, but marketing.
Budgeting.
Budgeting. Yes. Capital management as well, yes.
To evaluate if you are
Yeah.
overcapitalized
Mhm.
and if you have the chance to return capital to
Yeah.
the office.
Yeah.
Nowadays it's hard, and in the future it's harder
Yeah.
to say, okay, take it
Yeah.
back because I don't
Yeah, yeah. The other is that this is a good point, because how do you declare dividends, shareholder dividends? You declare shareholder dividends up to now based on statutory accounting. What are you going to do with respect to shareholder dividends? What's going to be the standard, right? Yeah, but what's statutory? So is the SUSEP going to tell you you have to do IFRS 17 or not? They most likely they will say yes, you do IFRS 17. But one case in point is Mexico, for example. Mexico said the regulator for now says no. You don't. For now, we have not taken position regarding IFRS 17. So you do your reporting based on the Solvency II balance sheet, which is, I'm going to criticize that tomorrow. It's not a very good approach, but this is what the regulator is saying now. But actually, you will have to do, I assume that you will have to do what SUSEP tells you to do. Yeah. Yeah. And it's very likely that they will say IFRS 17, right? It's very likely. Yeah. Okay. Let me see. Oh, all this is not a. All this is Spanish. Yeah, I think I made a mistake. So, yeah. So these are some activities related to the contractual service margin. So the booking and also the updating of the contractual service margin and the adjustment for risk. Okay, so that's an activity. Who does that? Who does this adjustment? Typically, we say the actuaries. What we have seen in most companies that we are dealing with is the actuary who is in charge of that. Then calculation of the loss component, and we haven't spoken about the loss component. The examples that we gave, we didn't identify separately the loss component. We have to disclose that. We will do that tomorrow. Okay, so that would be not necessarily actuarial. That could be an accounting process. Then what about the bookkeeping in the general ledger? That's an accounting function, okay? So that's clear. We are still talking about the contractual service margin. Now, here we have a problem. That is that in the general ledger of the company, in Spanish we say el libro mayor. I don't know what's the word in Portuguese, but this is like the main I don't know, the main book, right? Where you have your all your accounts. You don't have contractual service margin information. Nobody has had that in the past. So this is information that is not there. Who is going to do that? Well, this calls for adjustment or adapting the accounting system. Then reconciliation, okay, reconciliations. So what here we did 4 reconciliations. We did first the present value of cash flows. Second, the risk margin. Third, we did what was the third one? The contractual service margin. And then 4, the insurance liability. Who is going to do these reconciliations? I think that this is accounting, mostly. I think this is an accounting function to do these reconciliations. Then the notes to the reports, to the financial statements. I think this is actuaries and accountants. I think it's going to be driven by accountants, but they need actuarial input because you will have to disclose the methodology used in the calculation of the risk adjustment for non-financial risk and also the confidence level. And last, updating of accounts because of due to changes in currencies. Well, I would think that this is accountants doing this type of work. So this is only one thing, the CSM. Okay, so what we have illustrated here in this slide is who is going to do what. I think the bulk of the work is going to be done by the accountants, but they cannot do everything. They need actual input by all means. What about IT? Well, again, in the morning I said IT needs to be invited to the room. I find it I don't know, a bit strange that IT people are not in this room. I would have expected a few IT experts because this is something that I would think is very important, very relevant. Okay, then some thoughts about the convergence of actuarial, finance, and risk management. At least I'm going to tell you the European case where traditionally actuaries are here, finance function is there, and perhaps risk management is in the next building, right? So this is the so-called traditional model where actuaries don't speak to anybody. Okay, actuaries speak with actuaries, right? And this traditional model is suboptimal for IFRS 17 purposes. Now you need all these three areas: the finance function, the actuarial function, and the risk management function working together. This is very important. So we have a list here. Again, you will receive these in English. So these are the trends that motivate the convergence of functions, whatever, macroeconomic, regulation, business environment, globalization, reduced margins, etc. So there's always the question: who is going to be the leader of an IFRS 17 implementation project? Is it the CFO? I would say that in most cases the CFO would be the leader, not necessarily. Could be in some companies, it depends how the company is structured. I've seen companies where the actuarial function reports to the CFO in some companies, right? In some other companies, there's different story. The risk management function usually reports to the board directly, okay? So risk management is probably also interested in IFRS 17, but this is about operations and about interaction of finance and actuarial. And here, this is a implementation scheme. So we have IT and applications. We have a corporate strategy and organization. We have accounting and internal processes. Okay, so these are the things that are needed right away. Solid knowledge of IFRS 17, business requirements, objective operating model. Analysis de brechas means gap analysis to see what we have in resources and what we lack. Operating impact, assessment of operating impact, definition of implementation, definition of resources, and also budget, all right, presupuesto, budget. So these are some things that are needed. And then by area, typically IT would have evaluation of systems, implementation, testing, and migration to whatever new system is going to be used. Corporate strategy, product, they have to revise products, portfolio, strategy, metrics, accounting, accounting framework, training, process redesign, and re-expression and comparability. And then you have something at the bottom, which is support. So this is change management, project management, and so on. So there's, as you see, there's a lot of here in this particular slide, we have everything divided into three main functions plus a supporting function. the tasks that need to be carried out. So it's a sort of a complex environment for everybody, and the sooner companies start to pay attention and to plan, the better. Okay. All right. So this is it for today. Any remaining questions? We still have 30 seconds. Yeah.
If there are no questions,
Huh?
if there are no questions, I can just end.
No questions? Okay. Thanks so much.
Guys, thanks very, very much for coming. Of course, tomorrow we have more excitement. We have, treatment of group contracts. We have data management strategies, okay, all at 9 o'clock happening here. So, look forward to seeing you guys again. I actually wanted to emphasize something before we leave, is that I think this is, in my opinion, this is a lot more than accounting change. This is how we measure metrics. This is how we define success. Okay, and a lot of stuff is going to change, of course, right? Capital requirements are going to change. It depends on regulation. Tax is going to change. Business strategy, decision making, speed, how we implement new products or take products off. And here, I think actuaries have a great opportunity to be the next generation of leadership of insurance companies or in pension funds and things like that. I think the Society of Actuaries once had a slogan that said, risk is opportunity. And I think this is a huge opportunity for the actuaries to be at the forefront, working with, of course, IT and accounting, of course. But certainly, I think the actuarial profession has taken the lead on this aspect. I mean, the full room here, basically full of actuaries, shows the actual leadership of this very important topic. So, so let's seize the opportunity and, and definitely, contribute to this, the future of this enterprise. Thanks very much, guys. See you tomorrow. Bye-bye.